Today we're going to talk about a term that comes up often in investing and taxes: basis. Sounds simple, right? But it's one of those things that can either save you a lot of money or cost you if you don't understand it. Let's break it down. So what exactly is basis? At its core, basis is the amount of money you have invested in something. Think of it as your starting point for measuring gains or losses when you sell an investment. It's what you paid for an asset plus any extra costs related to it. Let's look at an example. Say you buy some shares of stock for $1,000. That's your basis in the investment. If you sell those shares for more than $1,000, you've made a gain. If you sell them for less, you've got a loss. Now, your basis isn't always set in stone. It can change based on a few factors. Let's say you own a rental property. If you make significant improvements to that property, like adding a new roof or upgrading the kitchen, that can increase your basis. On the flip side, if you claim tax deductions like depreciation, that can lower your basis. This is important because when you sell the property, your gain or loss is based on the adjusted basis. So why should you care about basis? Simple: taxes. When you sell an asset like stocks or real estate, the IRS will want to know how much money you made. They calculate your taxable gain by looking at the difference between the sale price and your basis. If your basis is high, your gain, and therefore your taxes, will be lower. If your basis is low, you might have to pay more taxes. For example, if you sell those shares of stock we talked about earlier for $2,000, but your basis was $1,000, you've made a $1,000 gain. That's the amount the IRS will tax you on. Now here's where people often get tripped up. One common mistake is not keeping track of the basis correctly, especially if you've owned an asset for a long time or if you reinvest dividends or make improvements to property. Not knowing your adjusted basis can lead to higher taxes, which we definitely want to avoid. Another area to watch out for is inherited property. When you inherit assets, you get a stepped-up basis. That means the basis of the asset is adjusted to the market value at the time of the original owner's death. This can significantly reduce your tax burden when you sell the inherited asset. So how can you make sure you're tracking your basis correctly? Here are a few quick tips. 1. Keep records. Hold on to receipts and documentation of any improvements or reinvestments you make. 2. Know your brokerage's records. If you're investing, your brokerage should provide you with cost basis report, but it's always good to double check. Keep in mind that prior to 2011, brokerages were not required to keep track of cost basis. A lot of older accounts are difficult to track down the cost basis, so you want to make sure you reach out to your brokerage firm to find out whatever information you can obtain. Work with a tax professional. Especially for things like real estate or inherited assets, a tax pro can help make sure you're calculating everything correctly. And that's the scoop on basis. It might sound a little technical, but it's super important for anyone who's investing or managing assets. If you found this video helpful, hit that like button and subscribe for more tips on personal finance and investing. Thanks for watching, and I'll see you next time.